Hello, everyone. Welcome back to another episode of the Weekend Charts. I'm your host, Charlie Bilello, bringing you once again the most important charts and themes I'm seeing today in markets and investing. If you're watching this on YouTube, join 33,000 other subscribers and hit that subscribe button. Don't miss all of the latest content from us. Hit that subscribe button now. We have a lot to talk about this week. Buy in May and stay. This is my preferred saying to that old adage, sell in May and go away. No validity to that whatsoever. We'll discuss how once again this year stocks proved that selling in May not a good idea. Active managers go all in, so sentiment indicators, some of them hitting extremes. Active managers going leverage long. I want to talk about that. A narrowing advance. S&P 500 still hitting all-time highs, but some weakness underneath. Big tech, big profits, huge earnings beats pretty much across the board from big tech. We'll talk about that and the overall S&P 500 earnings picture. The end of QT, so we had the Fed announcement as expected. Fed cutting rates again and announcing an end to their quantitative tightening program. So we'll dig into that. More sellers than buyers. That would be the U.S. housing market, and that's causing price appreciation to slow and even price declines in many cities around the country. And we'll end with something positive, as we always do, and that would be more affordable rents. So here we go. Buy in May and stay, and look at the S&P 500 off of the April lows here. You can see 43% advance, hitting all-time highs once again last week. Just a few milestones I want to talk about in the major indices here. First, the Dow hitting 48,000 last week for the first time. And we have the NASDAQ Composite 24,000 for the first time. And then the S&P 500 crossing above 6,900 for the first time. So all three indices hitting record highs. The S&P 500 has now hit 36 more all-time highs this year. That follows 57 in 2024, which was one of the strongest years in history. And really, if we look at the last 12 years, since 2013, we haven't seen anything like it. More all-time highs over this 12-year period than we've seen in any 12-year period in history. And the S&P 500 since the end of April is now up 24%. So through the end of October, May through October period, this is the sell in May supposedly period. Well, if you sold at the end of April, like a lot of the headlines were telling you to, you would have missed out on a 24% gain this year. And if we look at historically why I say you should ignore that sell in May and go away, well, basically, the stock market is still positive during that period on average. And yes, the return is lower than the November through April period, but still positive and still up 72% of the time. And this year proving once again that that's a terrible rule of thumb, the sell in May and go away. 24% would have been the gain that you would have missed out on if you listened to the headlines. So ignore the headlines, ignore that warning. Much better to buy in May and stay than to sell in May and go away. Active managers go all in. So I don't often talk about sentiment except when it's at extremes. When there's extreme optimism or extreme pessimism, then it tends to be a signal. But other times, if you look at the rest of the readings, it's almost always just noise. And so we have a few potential signals here in terms of sentiment. First, active managers. So they do this survey every week asking active managers, how are you positioned in terms of the equities market? What is your exposure to the equities market? And in their most recent reading last week, they reported over 100% exposure on average to the equity market. So that means they're using some leverage on top of their portfolio. And we haven't seen this exposure in quite some time. We haven't seen it actually since July 2024. That was the last time active managers were leveraged long here. And very interesting to see that with the S&P 500 at 6,900, now active managers are going all in. If we go back to April, the S&P 500 was below 5,000 briefly there, and active managers had dropped their exposure all the way down to 35%. So that doesn't tend to be a great indicator when following these active managers at extremes. So when they get very pessimistic and drop their exposure, you tend to see above average returns. And when they go all in, as they did last July, you tend to see some weakness. And I'll show you that in a little bit. But first, let's talk about Investors Intelligence. This is another weekly report on sentiment here. And essentially, they're digging into various newsletters and saying, well, what are the percentage of newsletters that are bullish, bearish, or neutral, correction territory? And what they essentially saw last week was the lowest percentage of bears. 13.5% of these newsletters were bearish. That was the lowest that we've seen since January 2018. So you have to go back a long time. And I'm just showing you where we've gone over the last few years. We were at 44% bears in October 2022. If you remember, that was during the bear market in 2022. It actually bottomed there in October, but you had 44% bears back then, and the S&P 500 was at 3577. Today, 6,900 for the S&P 500, and the percentage of bears only 13%. So just looking at those two indicators, last time they were at these types of extremes, what actually occurred? Well, if we go back to January 2018, last time bears were this low, you actually saw an 11.8% correction for the S&P 500. In 2018, the S&P 500 actually finished down that year. And if we go back to July 2024, when we saw active managers go all in the last time, we had a close to 10% pullback in the market. So needless to say, you don't have to have a correction of a certain magnitude. You don't have to have a correction at all. But what you tend to see when people are excessively bullish is below average returns. When they're extremely bearish, it's the opposite. You tend to see above average returns. So back in April, when sentiment was very weak, I was talking about the average return tends to be higher when sentiment is this negative about the market, and we've definitely seen that. And now we have the opposite situation. So it will be interesting to see if the market will continue to push higher despite this extreme sentiment, or we will see a pullback like we saw these last two times when we had sentiment at this type of extreme. And another way to look at sentiment is simply looking at valuations in terms of some of the most frothy stocks, in terms of the stocks where investors are really, really optimistic. And I always come back to Palantir over the past few years just because it has the most extreme forward PE that I've ever seen for a company this size. You're talking about a $400 billion plus company now for Palantir. It now has a forward PE ratio of 235x. So we have many different examples that we could look at. I've talked about last week about the return of SPACs. Meme stocks are back. We're seeing leverage products being filed for 5x leverage, perpetual futures in terms of crypto. And here's just one more example where investors seem to be taking more risk and they seem to be getting a lot more optimistic. So we're seeing it in surveys, we're seeing it in active manager surveys, and we're seeing it in terms of the valuations of some of the hottest stocks in the market. So let's talk about the narrowing advance that we're seeing in the equities market here. First, I want to discuss trillion-dollar milestones for companies. And what we're seeing today is the first $5 trillion company, but here's the evolution. Apple became the first trillion-dollar company back in August 2018, crossed above that trillion-dollar mark. And then 2 years later, in August 2020, it became the first $2 trillion company. And less than 2 years after that, in early 2022, it became the first $3 trillion company. And then Apple, during this AI boom, has been surpassed by NVIDIA, and NVIDIA in July becoming the first $4 trillion company in history. And now just a few months later, NVIDIA becoming the first $5 trillion company. You could see 10 years ago, this was a $15 billion company, and now $5 trillion. Just an unbelievable advance, fastest growing company that we've ever seen in history. And in terms of the market, in terms of concentration, I have to update you on these charts here because we're seeing yet more records here in terms of the concentration in the S&P 500. 8.6% is now the NVIDIA weighting in the S&P. That's the largest for any individual company in the S&P 500 going back to 1980. Apple last year was 7.6%. That was a record, and now we've added a percent to that, and NVIDIA taking hold here as the leader of the market. And NVIDIA, Microsoft, and Apple, when you put them together, the top three holdings in the S&P 500 now 22% of the index. That's also a record high going back to 1980. If we look at the top five, 29%. Yes, that's a record high too. And if we expand it to the top 10 holdings in the S&P 500, now over 40% of the index in just these 10 stocks. So concentration is increasing in the S&P 500. And why is that happening? Well, simply put, the biggest names in the index are outperforming the other names in the index. And the easiest way to look at that is simply looking at the average name in the S&P 500, so the S&P 500 equal weight index, and compare it to the overall S&P 500. And you can see by this chart here, the ratio of the two. A falling ratio means the average stock in the S&P 500 is underperforming the broader index, and you can see it's been going down. Now it's at its lowest level since April 2003. So for a long time after the dot-com bubble burst, you saw the equal weight index really outperform the overall S&P 500. And the last decade, of course, we've seen the opposite. In the past few years, we've really seen the opposite, and that's just because the biggest names, the names that are benefiting most from artificial intelligence, the big tech names, they're outperforming the rest of the index by a super wide margin. So within the S&P 500, within the NASDAQ 100, within the Russell 2000, it's not a rising tide lifting everything within the index. I'm showing you here the percentage of companies as of the end of October with a negative return. You see 40% of the NASDAQ 100 is actually down this year, 42% of the S&P 500, and 52%, so more than half of the companies in the small cap Russell 2000 index are actually down year to date. So indices are hitting all-time highs, but that doesn't tell the full story. The average stock, if we look at a small cap company, is actually down on the year. Let's talk about big tech, big profits. So this is the big driver of those charts that I just showed you. Why is big tech becoming bigger as a percentage of the S&P 500? Why is the index becoming more concentrated? Because we're seeing higher revenue growth, higher earnings growth out of these biggest companies. We'll start here with Apple showing 8% increase in its revenues over the last year. That hit a new Q3 record of over $100 billion in the latest quarter, and net income grew 92% year over year for Apple to a Q3 record of $27 billion. And Apple is transitioning to becoming more of a services company, and that's helping its margins. Gross margins actually increased to 47.2% during the quarter. It was the second highest quarter ever for Apple. So Apple, extremely strong earnings report there. Google as well, hitting record highs after a better than expected earnings report. You saw revenues there go up 16% year over year, hitting a new record high of over $100 billion for the quarter. Net income for Google was up 33% over the last year, hitting a record high of $35 billion. And the cloud, you could see here a huge growth there, beating expectations, up 34% year over year to $15 billion in terms of the cloud revenue for Google. Microsoft, huge beats across the board, 18% revenue growth over the last year. Revenue there at a record high for Q3, $78 billion. Net income growing 12% year over year. That was a record too, $28 billion for the quarter. And Azure, their cloud service part of Microsoft, that grew 40% year over year, beating expectations. Moving on to Meta here, 26% revenue growth, so highest among these big tech companies that have reported so far, and that hit a record revenue number of $51 billion. Net income went down because of a one-time tax charge. That's not expected to continue, and Meta stock sold off despite this because people seem to be fearful of the huge increase that they're expected to make in capital expenditures. Let's talk about Amazon here, though, hitting a record high after earnings here. Revenues increased 13% year over year, hitting a new Q3 record, 180 billion. Net income up 38% year over year to a record 21 billion. And AWS, huge part of Amazon's growth story, 20% increase over the last year to a record 33 billion. And the stock jumped over double digits after its earnings report, hitting a record high. And just to show you the AWS growth, just absolutely incredible growth over the last decade plus here. Now 122 billion in terms of the last 12 months for AWS, Amazon's cloud division there. Now they're up higher. This is a higher revenue number than 465 companies in the S&P 500. So if AWS were a standalone company, it would be among the biggest companies in the S&P 500 by itself. Amazon, big news, came out last week. This was expected to come, but we got the final numbers on here. 14,000 layoffs announced in terms of corporate workers, their biggest reduction in force ever. And they're saying the reason behind that is they want to invest more in AI, and the markets seem to like this news. Amazon increasing profitability, increasing their margins. The stock, as I just said, hitting a record high. This is the growth of $10,000 since Amazon's IPO back in May 1997. You're talking about $10,000 growing to now 25 million. Just one of the biggest growth stories we've ever seen in history. And a decade ago, if we look at October 2015, that 10,000 was just 3 million. So you've seen enormous growth in the last decade from Amazon. You could see it here on the revenue chart here, where it was back in 2015, where it is today. And if we look at the big four together, Amazon, Apple, Google, and Microsoft, you add their revenues up over the last 12 months, you're talking about now 1.8 trillion in combined revenue. And that's bigger than the GDP of all but 15 countries around the world. So enormous, enormous revenue. When you put them all together, they're bigger than most of the countries around the world. And let's take a look. Overall, we have 70% of companies reported so far in the third quarter. Sales up 5% year over year, so above expectations in terms of sales. But as I just showed you with all of the big tech companies, they're all above this sales number. So Apple, Amazon, Google, Meta, Microsoft, all well above this in terms of their sales growth. And really the big story is not the top line, not the revenue growth, but the bottom line. And we're seeing we still have 30% of companies to be reported, so this includes some estimates, 19% earnings growth over the past year. That would be the best quarter if that holds for the S&P 500 in more than 3 years. And if we look at overall last 12 months operating earnings up to 253 for the S&P, and basically this is a 12% now increase on a year over year basis. So beating expectations. This number has risen over the past few weeks because more companies have beaten expectations than missed expectations. And if you look at expectations for Q4, those have been lifted as well. So we talk about earnings growth, we talk about sales growth, and earnings growth up more than sales growth. So companies becoming more profitable. And basically what that means is their margins are going higher. And here's the projection. We still have 30% of companies to be reported, but 13.4% looking at the third quarter in terms of the operating profit margins for the S&P 500. That would be the second highest quarter on record. Got to go back to 2021. It was the only time it was higher than today. Let's talk about the Fed and the end of quantitative tightening. And as expected, first, the Fed cut interest rates another 0.25%. Now they've cut in total 1.5% since September of 2024. They moved rates down to 3 3/4 to 4%. So that's the new range. And they decided to end quantitative tightening on December 1st. So essentially, the Fed becoming more easy in its policy here, lowering the interest rate, getting closer to the rate of inflation, which is around 3%, and they're no longer going to be reducing the size of their balance sheet. And basically, they're saying they care more about the weakness in employment now than the rise in inflation that we've seen in recent months. And that is why they're cutting interest rates. And you had not unanimous here, but almost unanimous voting against the policy action. Stephen Mirren, who preferred a 0.5% cut at this meeting, he said the same thing last month. And Jeff Schmid here saying he preferred no change. And in terms of the balance sheet, we have one more month now where it will be shrinking, and the Fed then will level it off. But it's really stunning that the Fed can't even get back to where they were before 2020. So we are 5 years now removed from the 2020 recession. Expansion is 5 years in duration. Markets are at all-time highs. Credit markets are booming, and the Fed cannot continue to let these securities roll off of its balance sheet. They're saying that they need to, for the stability of markets, they need to end quantitative tightening. I don't agree with this. I don't think the Fed should have a $6+ trillion balance sheet, and they certainly shouldn't be allowed to buy $1 of mortgage bonds ever again in the future, given the damage that they caused from their actions in 2020 and 2021. But if we look at the Fed in terms of its balance sheet and the stock market, this is a myth that I've often talked about that needs to be busted, because there's really not as much of a relationship as people think. And to give you an idea here, the last 3 years, the Federal Reserve's balance sheet has shrunk 24%. So massive reduction, biggest reduction on a percentage basis ever for the Fed's balance sheet, and the S&P 500 is up 90% over this period of time. So the stock market definitely does not need quantitative easing to go higher, as many suggest that it does. But in terms of inflation here, what the Fed is essentially saying by cutting interest rates with the highest inflation that we've seen in 16 months is that they're ignoring their inflation mandate. They're ignoring that 2% target. We never got to the 2% target. We got as low as 2.3% in April, but never got to the 2% target. And yet they're cutting interest rates and planning on continuing cutting interest rates. And the reason they're saying that they're doing this is because they're worried about the employment picture in the U.S. Unemployment rate at 4.3%. We're now lagging in terms of data because of the government shutdown. But if you listen to Powell's comments, they're still concerned about weakness in the labor market, and that was the big factor driving them to cut interest rates. But you're seeing some more dissension in the ranks in terms of the December meeting. So before the announcement last week, market participants were saying almost definitely the Fed is going to cut again in December, but that changed after the press conference. Jerome Powell putting some doubt into the December meeting, saying it's not a done deal, it's far from guaranteed. And you have these other Fed members as well, Fed presidents in the recent speeches saying that perhaps they should pause here, perhaps we should wait and see, particularly with the lack of data due to the government shutdown. So if we look at the odds for December, big shift over the last week. You had a 94% chance of a cut just a week ago at that December meeting, and now we're down to 66%. So still more than 50-50 in terms of people thinking the Fed are going to do one more rate cut in the last meeting of this year, but not a done deal. If we see a hotter inflation print, it will be much harder, I think, for the Fed to justify it. And if we ever get the government data back, if the shutdown ends and we see the employment picture improve, maybe that cut is removed. But if we look at January, it seems like between the two meetings, if it's not December, then perhaps it'll be January. We're going to see at least one more rate cut here in the next few months, bringing the Fed funds rate down to 3.5 to 3.75%. If not by the end of this year, then investors seem to be betting that will happen at the January 2026 meeting. Let's talk about the housing market here quickly. More sellers than buyers, and this is a chart I keep coming back to because it displays this. This is out of Redfin. Sellers 1.9 million, buyers 1.4 million, so you have a 500,000 spread between the two, and that's causing price appreciation to go down. If we're looking at national home prices, this is as of August, so it's lagging by a few months, but 1.5% increase on a year-over-year basis, slowest rate of appreciation for national U.S. home prices that we've seen in a few years. If we dig into the Case-Shiller 20 City Index, this gives you a more granular picture. We have now 9 cities that are down on a year-over-year basis. We're talking about cities in Florida, Miami, and Tampa showing the biggest declines here, but you also have other areas. Texas, you see Dallas down 1%. And so a number of cities are shifting to a more balanced market in terms of buyers and sellers. And these markets in particular, like I talked about last week in Texas and Florida, way more sellers now than buyers, causing prices to go down. So where's this going to go in the next few months? It seems likely we're going to have more cities churn into the red here, more sellers than buyers. And the big factor, once again, is that affordability picture. So housing prices simply too high for people to afford based on their incomes. So that's causing very low demand in the market. And now finally, you're starting to see more supply, more people listing with that lock-in effect from the mortgage situation starting to ease. So it's now been a few years since that lock-in effect started. You have more people looking to move, more people accepting that interest rates are probably not going back down to under 3% anytime soon. So maybe now is the time to start listing my house. And you're seeing that in particular in areas that are already starting to see decline. So if you're looking at Florida, many areas now are down year over year. And so if you're waiting, saying, oh, I think they're going to come back up again, well, now that's starting to shift to people saying, well, maybe I should sell before it goes down even more. So this will be interesting to watch heading into 2026 in terms of, will the housing market finally start to become more affordable? And then will we see, as a result, more transactions? I think that will be the case. I hope that will be the case, that we finally see that transition to more affordability in the housing market. And speaking of affordability, I want to end, as we always do, with something positive. And once again, it's the more affordable rent. So biggest segment of CPI by far is what people pay for housing. It's their monthly housing payment. So this is a huge, huge positive for many Americans that rent their homes or they rent an apartment. You're looking at the monthly rent here now down 0.9% year over year. This was the 29th consecutive month where we saw a year over year decline in the national median rent in the US. And here's the picture in terms of the nominal rents. So nominal rents actually peaked in 2022, in the middle of 2022, and we're actually lower today than back then. So we're talking about now over 3 years where rents haven't hit a new high on average. And as a result, rents are becoming more affordable because over the last few years, people's wages have gone up. So each and every month that this picture stays like this, where we're not seeing rents go up, but we're seeing people's wages go up, rents become more affordable. And in all 50 major metro areas in the US, it's cheaper to rent than it is to buy because of that affordability picture and the housing market being as low as it is, and the rental picture becoming better and better because we're not seeing new highs in terms of rental prices, but people's incomes are going up. And what's driving that? Well, it's simply supply and demand. Vacancy in terms of multifamily units here, another new high. This is out of Apartment List, 7.2% now. So this trend should continue at least for a few more months where rents become affordable. Very good thing for many Americans in the U.S. that are struggling to afford that monthly housing payment. Okay, we'll end it right there. Thank you everyone for joining me on the Weekend Charts. Have a great week, and I'll see you next time. If you're watching this on YouTube, take a quick moment and hit that subscribe button. All